Look at the US debt clock in Times Square, or pull up the Treasury's own number. It's so large your brain refuses to treat it as real. The debt didn't just grow in last few years. The cost of carrying it surged. And once interest becomes one of the biggest lines in the budget, the system becomes a machine that starts feeding on itself. Welcome to the debt spiral. The US government is now paying interest on a debt load in the mid-$30 trillion range. The annual interest bill has moved into the neighborhood people associate with $1 trillion, depending on which measure you use and which fiscal year you're looking at. That is not a normal line item. It's the price of yesterday's borrowing becoming a first-order constraint on today's politics. In a normal household, too much debt triggers a basic response. You cut spending, you downsize, you stop pretending. But a government is not a household. A huge portion of U.S. spending is politically locked. Social Security, Medicare, defense commitments, existing contracts, and now debt service itself. These aren't optional. They're promises, laws, and constituencies. So when interest costs rise, the government doesn't behave like a household. It behaves like a leveraged institution. It borrows more. This is the mechanism most people never internalize. If you're running deficits and your interest bill rises, you have two choices. One, you cut spending or raise taxes enough to cover the higher interest. Or two, you borrow to cover it. In the United States, option one is politically radioactive. Option two is operationally easy, so it wins. And that creates the spiral. Higher interest cost, more deficits, more borrowing, more debt, even higher interest cost. And the terrifying part is that it doesn't require a crisis to start. It can run quietly. It can run normally. The government can look functional while the math turns predatory underneath it. Question is, how does a country get out? Historically, there are only three exits, and every country that loads itself with too much debt ends up pushed toward one of them. Option 1, austerity. That means raising taxes and cutting spending aggressively enough to run sustained surpluses. Not trim waste, not find efficiencies, real austerity, the kind voters feel immediately. In the U.S., austerity runs into a wall, an aging population, entitlement formulas, and a political culture that punishes anyone who proposes cuts that actually matter. Option 2, explicit default. You restructure, you delay, you don't pay in full. But for the United States, that's the nuclear option. U.S. Treasuries sit under the plumbing of global finance, collateral, bank balance sheets, pensions, pricing benchmarks. A clean default isn't just a domestic event. It detonates trust in the baseline asset the system is built on. Option 3, the soft default. You pay every cent, on time, in full. You just pay it back in dollars that buy less than the dollars you borrowed. You do it by letting inflation run above the average interest cost on government debt for long enough that the real value of the debt shrinks. This has a name: financial repression. It's not a slogan, it's a documented policy pattern used across history when debt is high and austerity is politically intolerable. The logic is mechanical. If inflation runs at 5% while the government pays 3% on its debt, then in real terms, the debt burden falls over time. Bondholders still receive dollars. Those dollars just carry less purchasing power than the ones they lent. It's a transfer, not a dramatic one-day confiscation, a slow one. Quiet enough that most people blame prices instead of policy. The soft default path only works if the system can keep interest rates from rising too high for too long. Because if rates rise in line with inflation and stay there, repression fails. The debt doesn't shrink in real terms. It becomes more expensive to carry. For decades, the story was simple. The Federal Reserve is independent, and it will raise rates to crush inflation if needed. That story starts bending when the debt gets large enough that sustained high rates become fiscally destabilizing. Economists call that risk fiscal dominance. Monetary policy starts operating under a government financing constraint. Not because someone announces it, because the math enforces it. Higher rates fight inflation, yes, but it also raises the government's interest bill. And when that bill is already enormous, every rate move becomes budgetary, and every rate political. At a certain point, the central bank can still raise rates, but keeping them high becomes harder to sustain without forcing severe fiscal stress somewhere else. That is the trap.
And once you're in that trap, you don't need a dramatic crash to break people. You just need time. Because the quiet version of default isn't a missed payment, it's purchasing power decay. It's savings that earn less than inflation. It's wages that lag. It's asset prices outrunning incomes. It's younger generations realizing the safe path doesn't work anymore. The U.S. debt problem doesn't end with a single headline crash. It ends with a long era where the system chooses the path of least resistance. And the path of least resistance is dilution. To pay in cheaper dollars, to keep rates below inflation whenever possible, to make the debt smaller in real terms, and to make your savings smaller in real terms at the same time. This isn't about panic, but about understanding the machine while you still have time to think clearly. Once the machine moves into full survival mode, it doesn't ask for permission, it just runs. That raises the obvious question. If investors are rational, why would they keep lending at yields that lose purchasing power? Why doesn't the market just demand 8%, 10%, 12% and force the government to face reality? Because the Treasury market isn't a normal market. It has structure, it has rules, it has embedded institutional demand, and it has a central bank that can step in when market functioning breaks. Let's break it into 4 parts. 1. Structural buyers. Banks, insurers, pensions, and liquidity-driven institutions don't hold treasuries purely as a trade. They hold them because treasuries sit at the center of the system's definition of liquidity and collateral. In modern banking regulation, high-quality liquid assets exist for a reason. Institutions are expected to survive stress by holding liquid, high-grade instruments. Sovereign debt from major issuers plays a privileged role in those frameworks. This creates persistent demand that is not the same thing as speculative desire. It does not mean treasuries can't sell off. They can. It does not mean yields can't rise. They can. It means the buyer base has a structural component, so the market is not purely a crowd of profit maximizers choosing freely between cash and bonds. A large share of the system is designed around treasuries as plumbing. 2. The central bank backstop. When private demand weakens or yields rise too quickly, the Federal Reserve has tools to intervene. The polite label is market functioning. The mechanical outcome is simple. The Fed can buy treasuries. Buying treasuries pushes bond prices up and yields down, and it injects liquidity into the system. In the modern era, the large scale of this has been called quantitative easing. The point isn't to debate ideology, it is to recognize the structure. If treasury yields are the foundation for mortgages, corporate debt, and collateral chains, then the authorities have incentives to prevent disorderly jumps. That doesn't mean rates can't rise, it means the system has shock absorbers. 3. The measurement layer. Official inflation measures are not fake. They are statistical constructs designed to measure price changes across a defined basket using a defined methodology. But your personal inflation rate can easily be higher than CPI, depending on what you spend on and where you live. If housing, insurance, childcare, groceries, and energy dominate your budget, your lived inflation can feel brutal even when the headline number is lower. That gap matters because policy reacts to the official measure. It guides rate decisions, indexation formulas, and the story the public is told about conditions.
So you can get a world where inflation prints manageable while daily life feels like the floor is moving. When that gap becomes persistent, trust erodes. 4. The distribution layer. Even when inflation is only 4% or 5%, the impact is not evenly spread. New money and new credit do not enter the economy evenly. They enter through channels: government spending, bank lending, financial markets, asset purchases. When liquidity hits asset markets early, assets reprice early. People who already own assets see nominal values rise sooner. People who rely on wages tend to see adjustment later, and often not fully. If system survival depends on preventing rates from rising too high for too long, while also preventing inflation from exploding, then the system is attempting something very specific. A controlled dilution, not hyperinflation, not collapse. A long period of modest to elevated inflation, with rates that, whenever possible, sit below it. It sounds manageable, but the compounding makes it lethal. At 4% inflation, purchasing power halves in about 18 years. At 5% inflation, it halves in about 14 years. You don't notice it in a month. You notice it when it is too late.